Hey, what's up everyone, and welcome to the School of Personal Finance. So it's been a pretty crazy week in the markets. The technology stocks, the high growth names that did so awesome last year, they've been getting clobbered this week. We had a hot inflation number come through on Wednesday. There's a lot of worry out there about rising prices. We're hearing about it all over the place, and that hits these high multiple stocks that don't have much earnings right now, but their earnings are coming in the future and they're getting discounted because of the anticipated inflation. So this has been leading me to have tons of conversations with people asking, is growth dead? Is the growth trade done for now? Are these high multiple stocks, have they just run out of juice and it's time to rotate into something different? And it brings me back to the same thing that I always preach to all investors, is that diversification is really key when it comes to long-term investing. Now, yes, it's a debatable topic. There are people out there like Mark Cuban and even Warren Buffett who have said that diversification is for losers, that it's a way to protect the ignorant. But in reality, when it comes to investing, none of us are out there in the trenches with these companies seeing how the inner workings of them go and their profitability and looking at the day-to-day operations to know enough to put all of our money into one company. There could be certain sectors, certain companies that we love, that we follow, that we feel like we know really well and that we want to invest in, but it's a terrible idea to invest all of your money in one or two companies with the hopes of getting rich. The tough thing is that it's worked out for some people, and there's a lot of FOMO that has gone on this year in the markets with companies like Tesla or things like Bitcoin, and you're watching people get rich off of crazy ideas like Dogecoin, and you have the fear of missing out, and you want to be able to, take $1,000 and turn it into $100,000, and you're watching it happen around you, and you want a piece of the action. But in reality, diversification is the best way to stay invested, to feel comfortable investing in the markets, to build long-term wealth. I do believe that you could target certain companies or specific industries or certain strategies if you think that those are going to do well in the future. Like, for example, if we continue to have inflation, there are strategies around how to invest during inflationary periods. But with that said, nobody really knows what is going to happen. So having some of everything and being diversified, I still believe that it is the best strategy going forward, and it always has been. So in this video, I'm going to talk a little bit more about diversification. I'm not just talking like stocks and bonds to have a 60-40 portfolio. I'm talking about real asset diversification, and I'm going to dig into what that means a little bit more. All right, let's get to it. So, I wish that I put all my money in Bitcoin 5 years ago, or that I put all of my money into Amazon 20 years ago, or all my money into Tesla a couple of years ago. And yes, there are people who did do that and they became multi-millionaires, and I'm very happy for them. But the truth is, that is 1 in a million. It's not an everyday occurrence that you see people getting rich off of placing a big bet and putting all their money behind one certain idea. Now, maybe you could make the argument for people that are self-employed that they invest in themselves, they invest in their company and all of their profits, they invest back into the business, and that's how they grow wealth. And that's what Mark Cuban was really talking about when he was talking about diversification is for losers. And in a way, I do agree that it is great to be able to build a business and invest in it and grow it into becoming wealthy. But for the everyday investor, it's just not a good investment strategy. And a lot of people are starting to feel the pain now, and who knows if it will continue as we see the air come out of these high-flying, high-multiple tech names. But I am worried about the retail investor and the newer investors who are betting it all on specific companies or cryptocurrencies or industries, and they might get clobbered. And if they do, they might not come back anymore. They might have a bad taste in their mouth. And in a way, it does remind me of 2000 and 2001 when I was a new investor and I did awesome, and then I gave it all back and it put a bad taste in my mouth. I remember very vividly, and I made a video about this. You should go back and check it out. The story of my first stock portfolio, where my portfolio went up 5x in a short period of time, and then it went right back down to where it was. And I was devastated about it, but I did learn from it, and I did stick to investing for the long term and diversifying and, dollar cost averaging through my 401k and things like that. So hopefully things work out, but people are losing a lot of money right now. Maybe they made it already and now they're just kind of giving it back. People who bought these high-flying stocks just a few months ago, they might be down 30 or 40%, and that's a terrible feeling, and it makes you want to go away from investing in the market and just think that it's a sucker's game. But we do live in the world and an investing environment that is unlike anything we've ever seen before. With the government programs that are going on, coming out of a pandemic, the reopening trade, we have this new asset class, digital cryptocurrencies that's unlike anything we've ever known or invested in before. We have all assets at basically all-time highs. We have real estate at all-time highs, stocks pretty much at all-time highs. We have gold and silver, which are starting to gain some traction. We have natural resources, all of them basically at all-time highs. We have copper exploding, the price of lumber exploding. We have people that think that the dollar is just going to completely go away in the near future. People preparing for shortages of food, for world chaos. Like, we just don't know what the future has in store. So how are we supposed to invest in this environment? And again, my advice is diversify. We just don't know. Own some of everything. So here's some negatives about diversifying. The first one is that you're always going to have something in your portfolio that is not doing well, right? If you own some of everything, then there's always going to be something that is unperforming, and it's just not sexy. It's just not that exciting. You're not going to get rich overnight by having a very well diversified portfolio. So from that point of view, it's just not that exciting, and people don't love to be overly diversified because they see their friends getting rich and they want to get rich. So why would I diversify? But on the other end of that spectrum, no matter how convinced you are that something is about to happen, you could be wrong. So if you bet everything on you being right and then you're wrong, then it sucks. Then it's like you got to start over, or you got to lick your wounds and move on, and you might not ever get over it. Now please, I'm just some guy on YouTube. Don't take anything I say as investment advice for you. This is just for education and entertainment purposes only. So now when I'm talking about diversification, I'm talking about looking at all of your assets and saying that it's 100%. So it's like a pie, right? So all of your assets make up 100% of this pie. And then how do you slice the pie? What percentage do you have in all these different asset classes? So let's say, for example, you are afraid of the dollar going down in value. You're afraid because the government, with these stimulus packages, we're just printing money. We have inflation. Inflation is already here, and you're worried about the value of the dollar, and you want to protect yourself. So you want to have a heavier weighting towards assets that will do well in inflationary periods. So let's say that the first asset class that you want to have as a big piece of the pie is real estate. So now your primary home would be considered in this, because that would be an asset that is real estate. And then on top of that, maybe it'll be rental properties. And if you do own rental properties, my strategy has always been to invest in multiple markets. I want to have some properties in like the Midwest, in lower cost of area living, and then I want to have properties in higher growth areas on the coast where I'm very well diversified, because real estate, as we know, is very market centric, and we just don't know which one is going to do better than the other year in and year out. So I would rather own a little bit of all of it. So I have my primary residence, and then I have my rental properties, and they are spread throughout 4 different cities. So I have diversification. And then the second piece could be natural resources and hard assets, and being diversified in there as well. So owning things like gold and silver, copper, lumber, a basket of all these resources which go up during inflationary times. And then the third asset class, which you can make a small sliver of your overall pie, and that's crypto. So if you want to invest in Bitcoin and Ethereum, I mean, there are some people that will argue that it should be 100% of your portfolio, and obviously I do not believe that at all. I mean, it's so speculative right now, and the volatility is crazy, where you have to go into it with the assumption that there's a good chance that you could lose a very large percentage of the amount that you invested in. But people who did put all their money into it a few years ago, they're very rich right now. But we just don't know what the future holds. So if anything, I think you allocate a very small portion of your portfolio just so you're in the game, so you have a piece of it if it really does explode. The next asset that's a piece of the pie is cash, is savings, is the amount that you keep in the bank, your emergency fund. And that's different for everybody depending on how stable your job, what your income looks like, how much it costs you to live every month. And even though I might feel like sitting on too much cash right now is not a great thing as we continue to print more money. We just don't know what's going to happen in the future, and we all need to have some cash in the bank in order to be able to pull from it, to have liquidity in case we need it for something. And then after that, we have assets in the financial markets, so stocks and bonds. And now with stocks and bonds, you want to be very well diversified inside of that asset class. So you don't want to put all of your money into high growth stocks or into value stocks or into dividend paying stocks. You need to be well diversified in that portfolio so that you have your hands in all different types of companies. You want to own large cap stocks, middle-sized companies, small companies, value companies, growth companies, dividend paying companies, international companies, because we just don't know year in and year out which ones are going to outperform what. We might have a gut instinct of what we think it is, and maybe we put a little bit more towards those types of companies that we think we're going to be doing well. Like for right now, you see a rotation going from these growth stocks to value stocks to the reopening plays. So people are definitely maneuvering and placing their bets, and I think that that is okay, but you want to have your core positions where you're very well diversified, because you just don't know from one year to the next what is going to outperform. And these investments in the stock market, you have to look at them as long-term investments. So when you're investing for the long term, there are so many different things that could happen over the next decade that we just don't know, and we can't see it coming, right? Hindsight is always 20/20. It's very easy for us to sit here and say it's so obvious that these tech stocks are getting killed right now because they've run up so much and inflation is coming. But until you're actually living in it, it is not obvious at all. So you have to be prepared for all different types of markets and be very well diversified. So I'm making the case here to you that you should be diversified, that it does not make sense to bet all of your money or to go all in on a certain sector, even though being diversified is not going to make you wealthy overnight. And that's what most of us want right now, is get rich quick. But investing, it is a long-term game, and it is a great way to build wealth, but it's slow and steady that wins the race, and you have to stick with it. And if you're betting, or if you're in all of these different companies that are going up 50% and down 50%, and you're on the wrong side of that trade a few times, you might just wash your hands of it and be like, you know what, this is not for me. But that's not what investing was meant to be. It's meant to be a long-term game. But if you are an individual that has so much conviction around an idea or around a company, and you want to invest more of your pie in that company, of your asset allocation, then go for it. But always leave yourself out. So don't put yourself in the position where you could get crippled if you're wrong and you have to put your tail between your legs and start from scratch, or maybe never even start again. But I do worry about the gamification of investing and the mentality to always buy the dip, that the markets always go up, because it's just not the case. We could have extended periods of time where the market goes nowhere, where we have a lost decade, which we had in the past, or where markets go down, where you actually lose money over an extended period of time. And people are looking for action, it feels like, especially new investors. They want action. They want to double their money as quick as possible, and they like the game. They like to be able to place bets on things and, watch these things soar higher and everybody's getting rich. But the reality of that happening for an extended period of time, it's just the chances, it's very low. It's very low that that's going to continue happening. So you have to be a smart investor and accept the fact that you might go through extended periods of time where it's actually very boring, where it's just not that fun. There's not the volatility. There's not things, there's not stocks and assets going up 30% a year, 50% a year, or 50% in a week. And with the bond piece of your overall allocation, you want to be very well diversified in there as well. And maybe it's a good time to be underexposed in bonds, considering we've had such a 30-year bull market in bonds and rates are starting to go up and inflation is on the horizon. Those are not great environments for the bond market. So if you're very young, then maybe you want very little to no exposure in the bond market. But again, it depends on your time horizon, on your risk tolerance, on many different factors. I'm not giving you investment advice, but maybe bond exposure is something that you want to have at a minimal right now as we start, the upswing in interest rates. Unless they're inflation protected bonds, then those might do very well in inflationary times. But that's my point. It's just so hard to know what's going to do well and where you should be. Everybody thought that bonds were going to be getting killed 5 years ago, 7 years ago, saying that the bull market is over in bonds, but interest rates continue to go down and bonds continue to perform well. But now we're at the point where it's like, things have to change with the bond market, right? We're going to start to see an upswing in rates and bonds will not perform under those conditions. But again, it's just, it's impossible to predict the future. All right, everyone, that is it for this one. I hope you found that helpful. Please hit the like button if you enjoyed this video. Hit that subscribe button if you're not subscribed to the channel as of yet. And I will see you again next week. Thanks.